Ladies and gentlemen, please welcome the 2013 Nobel Prize winner, the one and only, Lars Peter Hansen.
I think that's the most spectacular introduction that I've ever had. So anyway, thank you. Talk about the consequences of uncertainty today. And these topics that I'm going to address are really important to my line of research, and namely the analysis of how both economic researchers and the people that populate their models, say the consumers and enterprises, make decisions in the presence of uncertainty. As you'll see from my talk that I'm going to draw on, it's been aided by interest in mathematics, probability, statistics, and finance, along with economics. While uncertainty is unavoidable and pervasive in our lives, in many discussions of economic analysis, it unfortunately takes a back seat. I will discuss ways and reasons that we should instead push uncertainty to the forefront of our thinking. So as an economist, I build mathematical models, as do other economists. Why? Well, we want to represent clearly our understanding of the economy. We want to predict what happens in the economic environment is altered by things like changes in government policies, tax policies, exchange rate policies, monetary policies, and the like. The models that fascinate me capture the evolution over time of economic variables that are stochastic. They introduce random impulses or shocks that are transmitted through the economy over time. This randomness is only one component of uncertainty, however. Some attributes of these models must be revealed through the use of data. As part of economics being an evidence-based scientific discipline, it is our willingness to measure and acknowledge the uncertainty in our answers to important questions. This is not always well reflected in blogs and op-eds, but hopefully professionally we do a better job of this. Models are not exact replications of reality. They are simplifications and hence not perfect. Rather than dismiss imperfect models, I prefer to use them in sensible ways. The nature of these imperfections contributes to uncertainty, broadly conceived. So given my experience as an economist, I'm convinced of the importance of uncertainty as a central ingredient to building and assessing models. I'm convinced of the role of uncertainty in influencing economic decision-making. As I'll explain, there's several dimensions to this discussion that are pertinent to how economists build and use models. So, sometimes we feel anxious about unexpected economic downturns. The challenge of model builders is to incorporate that kind of anxiety and reluctance to go forward with new ventures in very uncertain times. Moreover, the challenge is to provide a more sober framework for assessing economic policies. So my plan today is to reveal some intellectual history showing our thinking about uncertainty and how it's evolved. And I'm going to draw on these insights in discussing why I think uncertainty should be a critical ingredient to economic analyses. So I'm going to skip the mathematics, I'm going to skip the formal economic model building, but I'm going to talk you through what I think are some really incredibly important subjects. So let me start off with Pascal. If we look at the initial contributions to probability, as an application of mathematics, the formalism, they were the games of chance. Flipping coins, throwing dice. There's this famous exchange of Pascal with Fermat about how to split the winnings in a fairly complicated or subtle coin flipping game. And Pascal at that point in time was able to appeal to his triangle to get more useful and tractable formulas for doing precisely this. But this is all about games of chance. Okay? Let me turn now to how probability theory entered in the realm of social sciences. About 300 years ago, Jacob Bernoulli came up with something that's called the law of large numbers. He actually came up with more than just that, but he came up with the law of large numbers. Jacob Bernoulli was motivated by using social scientific data. So this is a case where probability is really meaning data, and in particular social scientific data. So on the left-hand side, you'll see Jacob Bernoulli's picture here. And he was all about kind of how quickly from data we can figure things out. Instead of a game of chance, you know probabilities. And once you're looking at social scientific data, you have to estimate stuff. You have to use the data to reveal them to you. And it becomes a question of how quickly that can emerge or evolve. And that's kind of what Jacob Bernoulli put on the table here with his law of large numbers and refinements of that. So what's going on the other side of this plot, on the right-hand side? Well, the right-hand side is a picture by Pissarro. It's a marketplace in Rouen. So as people come in the market, they don't know what the price of their goods are, what price their goods are going to sell in the market. There's some uncertainty about how much goods to bring to the market, and they face that in their decision making. They also face uncertainty. So the people that, when we build economic models, there's kind of this outside perspective, this Jacob Bernoulli perspective. We're using the data from the model to try to figure stuff out, an econometrician or statistician's perspective. But there's also inside the model. We have people, like the people in that marketplace, we have to model them and then how they confront decision making. So I think of this as, from a model builder, uncertainty from two distinct perspectives that can be complementary. Okay. So here's how I'd like to draw this distinction between inside and outside a model. So the outside the model is the usual application in the field of statistics and for that matter, much of econometrics. You're given, say, some dynamic model. What you can do is you can estimate unknown parameters. You can assess the model implications and try to figure out how the model's doing. But then we also need to look inside the model. So when we're constructing the model, we have to depict our economic actors, consumers, enterprises. They cope with uncertainty. How they cope with uncertainty, that influences the consequences and outcomes that emerge from the marketplace. So both of these perspectives on uncertainty I think are really critical, and there's interesting interplay between the two, which I'll talk more about. So here's a field that I've been fascinated with and participated in called Timeseries. Economic time series, and it's got a really interesting history attached to it. Bachelet did important research using so-called Brownian motion models back in the 1900s. In some sense, he was one of the innovators of Brownian motion, and he had this insight that that'd be a useful way to think about financial markets. So these Brownian motions, we have these nicely behaved so-called normally distributed shocks. They repeatedly hit the market, and Bachelet thought, well, financial markets are having to cope with uncertainty. This is a way to think about that entire process. Bachelet does this work in 1900. It's discovered by economists 50 years later. Basically, Samuelson is told about it from a statistician, Savage. But it's a keen insight, and since the time of Samuelson, there's a field called kind of asset pricing and finance, and efficient markets is kind of built from the modeling insights of Bachelet. So Bachelet was a probabilist or a mathematician whose work was subsequently discovered and to be truly important. So another line of research was started by Ewell and Slutsky. Ewell's a statistician. Stephen Stigler, who's an expert in the history of statistics, describes him as the father of time series statistics. Ewell actually studied sunspots. Economists these days make fun of sunspots. When they talk about sunspot models, they view it as kind of, for some reason, we load up on uncertainty that isn't relevant. Ewell actually studied sunspots, and he was motivated by the fact that sunspots had an approximate cycle to them. I think it was like 8 or 9, or about 8 years or so. But not an exact cycle. So you couldn't fit it with an exact cyclical model, a so-called sine and cosine wave. You had to do something else. And so Ewell had this great idea of kind of imagining there's random shocks that hit the dynamical system, and they propagate in ways that are periodic. And so the propagation mechanism shows the so-called damp periodicity, and those are repeatedly hit by these shocks, sometimes big ones, sometimes small ones. And that's response patterns which can deliver approximate cycles. Slutsky, doing work out of Russia, the original work was done in the 1920s. It got translated into English a decade or so later, but at least formally translated subsequently later. Slutsky had hit upon the same models, the type of models that Yule was looking at about the same time. Slutsky was motivated by economic data, business cycle data. Slutsky realized that business cycles were not exact cycles, they were only approximate cycles. So he wanted models that would allow you to capture this approximate cyclical behavior. So what Slutsky does, Slutsky builds a model much like the model of Yule, where you're repeatedly hitting by these random shocks, okay? But they propagate in kind of a temporally dependent manner or a dynamic manner that can give rise to these approximate cyclical behavior. It was a keen insight, and if you look at the models that Yule and Slutsky are looking at, they kind of dominate, multivariate versions of them dominate empirical macroeconomics for the next several decades. Frisch, who is one of the, this is another story about Slutsky that's kind of interesting. These days we turn to computers and we have them do Monte Carlo studies for them. We kind of simulate data from models and the like. So Slutsky didn't have that at his disposal, but he did have some data from lotteries. So what Slutsky does is he takes these outcome from lotteries and he feeds it through his model. Then he compares it to British business cycle model. There's this remarkable plot in his paper that shows the two kind of track each other fairly closely. Now there's a little bit of a cheat in this because you ask, what are the chances that the shocks that hit the lotteries exactly match the shocks that hit the business cycle? Well, no doubt what he did was he took a very, very long simulation and then spliced off a stretch that looked exactly like the British data. But you got to cut him some slack here. He's doing this in the 1920s with no computer technology to help him do more systematic Monte Carlos. But it was a truly remarkable contribution. Frisch, who picked up on both Yule and Slutsky's contributions. Frisch is one of the two original Nobel laureates in economics. He picks up on their contributions and he starts putting economic structure to this. How can we take these probabilistic modeling insights of Yule and Slutsky and actually start thinking about it in terms of economics? He writes in the so-called impulse and propagation problem, the impulse being these random shocks, and then the propagation, how they might be transmitted, and really puts on the table, how do we think about economic models that can achieve this? So what does this have to do with Bachelet and efficient markets and the theory of finance? Well, if we think about shocks, okay, we imagined we're some type of insurance company wanting to insure a big population that's kind of hit by a bunch of independent shocks. Those set of circumstances, you can diversify or average out the uncertainty over the entire population, and it kind of vanishes on you, and that's called diversifiable uncertainty. Macroeconomic shocks, they hit everybody. There's no way you can kind of do this averaging trick to diminish their impact. And those are the ones that require the compensation. So the modern theory of asset pricing is kind of all about how to assign compensations to the macroeconomic shocks. So it's the macroeconomic shocks, the ones that Yule and the Yule Slutsky's work got us thinking about and Frisch was focusing on, are the ones that at the same time require compensation from financial markets. And the theory of finance is all trying to make predictions about the nature of those compensations. So kind of the merger of macroeconomics and finance kind of connects very much the work of the macroeconomists and with Bachelet's earlier contributions. So how do we start thinking, the models that Frisch was interested in had people inside them, investors and the like, making decisions. And economists cope with how to make those predictions and how to model people's expectations. And various different people took stabs at this in various ways. There's an approach that became incredibly successful in the field of macroeconomics and elsewhere. It was kind of the ideas were initiated by Muth, but my colleague Bob Lucas really turned it into a full-fledged equilibrium construct. It's called rational expectations. And the idea is that these economic actors, they go appeal to the law of large numbers of, say, Bernoulli. And with those long histories of data, they figure this stuff out, including the parameters. So economic agents figure stuff out. That once I write down the economic model, if I write it down completely, the expectations now get determined endogenously inside the model. It becomes a whole full stochastic notion of equilibrium. The expectations are are just determined endogenously, not something that you can make up from the outside. The other part of this breakthrough, not only an equilibrium construct, was a coherent approach to policy analysis. There's concern by many, I would say, and I would share these concerns, that if you want to build a macroeconomic policy, you don't want to build it on a premise on systematically fooling people over and over and over again, because sooner or later they're going to start figuring stuff out. By Lucas's use of rational expectations, it put off the table macroeconomic policies that required that were premised on systematically fooling people, and targeted more policies that had that were based on people figuring stuff out, but still being productive policies. So I think that was a tremendously successful part of this. The limits to this is that it neglected some components of uncertainty by featuring what I'm going to call risk. That is, economic agents figured out parameters, they figured out models, they just didn't know the shocks that were going to happen in the future. And so arguably maybe they had too much figured out. But I would say like the first half of my career was all about imposing rational expectations and looking at testable implications of it. So it's been just a hugely successful research paradigm. But where can we go from there? So this is a University of Chicago economist from a while ago, Frank Knight, was very concerned about uncertainty and uncertainty more broadly conceived. He was worried about a more narrow defined notions of risks and that we should broaden it. Now, lots of people claim to have read Frank Knight's book on this topic, and it's often cited. If you actually read the book, it's not the most coherent book in the world, and I suspect that not that many people have actually read it and studied it carefully. But he certainly put on the agenda this distinction, but trying to think about uncertainty more broadly. And here's a quote that I like, because it refers to the challenge that economists face in doing policy analysis. We must infer what the future situation would be without our interference, but what changes would be wrought by our actions. Fortunately or unfortunately, none of these processes is infallible or ever accurate and complete. So he's basically saying this is hard stuff we're supposed to be doing here, but at the same time, he wants us to acknowledge the fact that there may be gaps in our full understanding of things. And so I think this is the very, very wise notions here. So let me try to think about this going beyond the notion of risk here. So let me just start off with uncertainty can be risk. I think about that as the games of chance. Here I've got an urn. It's got a known number, say, of yellow balls and a known number of red balls. I can draw them out at random. I don't know I know the probabilities, but I don't know the outcomes. And so it's like I can write down models of what shock distributions would be, but I don't know what the outcomes are going to be. So I'm going to think about that as being risk. Now, uncertainty I'm going to use the concept of ambiguity in situations in which we don't know the number of balls. We can look at data, we can try to make guesses about things, so there may be an unknown number of red balls, an unknown number of yellow balls. Okay? So here's where Bernoulli comes into play. He wants to try to use data to try to figure this out. With enough data, one can start, getting more and more data. You can start figuring out, what fraction are red and what fraction are yellow. It may take a while, but you eventually figure things out. Now, in actual dynamic models, perhaps I think of the situation as potentially more complicated than this. Imagine there's a bunch of these urns, a different one for every different time period, and imagine the composition changes a little bit over time, maybe not dramatically, but a little bit over time. So you're using data, you're kind of chasing after a moving target, and you keep on confronting these urns, but that's with unknown numbers of yellow and red balls, but maybe not always the same number. This is the even more broader notion of uncertainty. And as we're as thinking about uncertainty inside and outside models, I think it's valuable to explore what happens as we push things to these much more broader notions. So let me just kind of summarize. I like to think about there being multiple components to uncertainty. Risk. Suppose I write down a model The model tells me probabilities of everything. It doesn't tell me outcomes, it tells me probabilities. I know for a coin flip, there's a 50-50 chance there are heads or tails. I roll the dice, there's a 1/6 chance of getting different numbers. Risk. Ambiguity. How much confidence do we place in each possible model? There may be a bunch of models on the table. We're not sure which is right. How much confidence do we place on this? Now, we can use historical data, can help guide that, but perhaps we never know, but that data may not be rich enough to reveal the model exactly. And third, I think, is perhaps the most challenging and in many respects the most important in lots of scientific enterprises, but certainly economics, model misspecification. The models we write down, they're wrong. We kind of know they're wrong. They're simplifications, they're approximations. Models by their very nature are simplifications. They miss stuff. How do we use models that we know are imperfect in ways that are sensible and ways that are valuable? And so I don't want to throw out models, but I want to be able to use them in ways that are sensible. And so I think the third is also a critical component to uncertainty, and perhaps the most challenging to formalize. So for the ambiguity part, there's I think of there being two important contributors to this that kind of initiated this theory of subjective probability. DeFinetti, and then followed by Savage. And so their notion was, how do we confront this model ambiguity? Well, through introspection or the like, we we think about things. We maybe from past history gives us some information that from that we kind of fill in the gaps of probabilities through subjective probabilities, through our own. Savage wrote a beautiful axiomatic treatment of subjective probability, and that I think really, in many respects, the gold standard to a field of decision theory that Isaac Gabor has been a major contributor to. So maybe they just solved the whole problem. Well, here, let me tell you a bit of a footnote. Savage was at the University of Chicago, so I happen to know more about him than others. He was in the statistics department there. And at some point in the stage of his career, he left because it was some personal issues came up and he moved to Michigan or something. And then maybe a year or two later, he wanted to come back. His college wouldn't take him back, not because he wasn't a great statistician, but because I guess he was a complete pain in the rear. And I often tell people in my department, we award pain in the rears. I think that's key to being promoted in my department. But anyway, the statistics department, where I also have an appointment, they're a little bit more friendly crowd. But anyway, so Savage was not welcome back, even though intellectually he obviously should have been. So here's a painting by Latour. That's in Paris, I guess. This is a version, I think it's from the, well, anyway, I will botch this. Anyway, so what's this putting on the table here? This has to do with this notion of model misspecification. So let me just start by the person all the way on the right. Apparently, an apparently naive person playing cards, thinking this is more like closer to a game of chance. Of course, there's strategic aspects to card playing as well, but there's some underlying probabilities about what cards might be dealt. Then there's this dealer who with the shifty eyes, look. There's a person pouring some beverage, perhaps wine, and then there's a person all the way on the left with apparently cards behind his back. So this is called the cheat, not surprisingly. So what is this doing here? So we could use models naively like the person all the way on the right, or we could use models that we know are wrong and start making guesses as to ways in which they might be wrong. So one algorithmic way to start making guesses on how things might be wrong is to do calculations. Well, if they're wrong in this way or that way, what might be the consequences be? And in terms of using misspecified models, that's about the best formalism which we have out there. So I want to think about this painting as a case in which is illustrating the fact that maybe we need to be thinking about models in more sophisticated ways to avoid the naive use of the person all the way on the right. Now, this painting has some interesting questions, too. There's two versions of this painting in two distinct art museums. Some people are conjecturing that one of the paintings itself is a fake, but it's also possible that Latour painted both of them. But anyway, I think I'll end the story here. Well, actually, there's another part of this story, too. Chicago is a rough place to work. Let me give you an indication as to why. Tom Sargent and I wrote this book. It's called Robustness. It kind of has a cover that looks a little bit like this. Actually, it looks quite a bit like this. Our book, because of, it's the publisher made us do this. We actually left off the person all the way on the right on our book, which seems remarkable given the message I just conveyed to you. Stephen Stigler, my colleague in statistics, expert on history of statistics, writes this updated version of where the robustness in statistics stands. He picks out this painting, notes some naive macroeconomist who abused the notion of robustness by truncating off the key part of the painting and destroying its main meaning. I asked Steve how friendly this was, and he assured me that all publicity in this game is good publicity, and he was hopeful that I would turn over some of the royalties from our book to him for the extra publicity. So anyway, but anyway, Steve was right that indeed this painting needs the person all the way to the right to have the full message of it. So I have to accept the criticism. Okay, back to discussions. So I think it's important to push uncertainty to the forefront of economic analysis, and there's different ways to do this. One way is to increase the exposure to uncertainty. Lots of models in both macro and finance these days invent rare disaster models. These are, sometime down the road, some big event's going to happen, and the fact that investors think it might happen has big consequences for asset pricing. It's a challenge for those models because you don't know how to set the probabilities of these potentially enormous events with big consequences. So, but certainly increasing exposure to uncertainty is one way to go, getting a more credible measure of how much uncertainty is out there. But I also think, and this is where decision theory comes into play, figuring out ways to enhance decision-maker concerns about uncertainty, have them respond to this uncertainty in sensible ways, and maybe to these different components of uncertainty in differential ways is also very, very fruitful. The third way that's been done in this linkage between macroeconomic finance is to impose frictions in financial markets. And then economists are really amazing at their ability to make up shocks. So we now invent shocks to these frictions. We invent these kind of normally distributed shocks that shift the frictions around and that drives the underlying time series. Now, models need shocks. I'm all in favor of that, but I get worried when the so-called shocks themselves do too much of the work. These are often shocks we don't have any fundamental or deep understanding of, and this is especially true, I think, in financial market frictions. So I want to talk about placing investors inside an economic model. So here's where I want to go beyond the statistician's perspective. What I want to do is be thinking about, I want to be thinking about the economic actors. I, for the first several years of my career, struggled with trying to figure out what the correct models are. But I assumed rational expectations, and so suddenly the agents inside my model had it right. There's even more tensions would show up. I've a long-time member of the macroeconomic or money and banking workshop at Chicago. It's a famed workshop going back to originated by Milton Friedman. There'd often be these papers where researchers would come in and they would be very proud of the fact that they had this full equilibrium construct imposing rational expectations. And then there'd be this 10-minute at the end, which would be a short discussion of empirical assessments. And I or others might ask, well, why aren't you being more serious on this part? They say, well, this model is just a rough approximation, so why do I want to look at the evidence all that seriously? And then you have to ask yourself, if the model is that bad of an approximation, to what extent does it make sense to give agents inside the model rational expectations, assuming this simplified model, which you know to be wrong? Anyways, it starts getting very, very circular. So it's kind of nice to get out of this box, or to think about ways to get out of that box. I think it's valuable to enrich how we think about economic actors as responding to uncertainty, pushing beyond the more narrowly defined risk model. And the interesting part of it is when it has implications for market responses and various consequences for how resources get allocated in the underlying economy. So here's a plot of real GDP and coming off the U.S. This is real GDP per capita. And you'll see the evidence, you'll see various different downturns and recessions. Macroeconomists often would argue that, well, there'd be these downturns, but would essentially move back to something very close to a trend line. And you know, people pre-crisis were writing that basically economic fluctuations is largely a solved problem. There's just minor stuff left. And then comes the financial crisis. So that's the big blip at the end there. And now there's lots of debates. Is that big blip, are we down permanently, or are we eventually wander back to to the earlier so-called trend line? And that's to me is kind of an open question and not at all clear. And there's lots of discussions about that. So let me just blow up the end of this. This is like the evidence, you know, going into the crisis and following it. So we have this big downturn. Do we fully recover back to some other, you know, fictitious trend line, or is this something that has permanent consequences, permanent outcomes? Now, this is output. In many respects, maybe series like investment are all the more interesting. Investments is the investment in new capital. That can help be the engine of growth going forward. So here's the investment series, which things are a little bit more positive at the end here. This is investment as a ratio to GDP. Again, you can see the financial crisis, the big drop in investment, and there's some evidence now that it's recovering back to a more normal state. But I would say, coming out of all this, as a macroeconomist, I mean, I wish I could tell you where the economy's headed with great accuracy. It's unknown. Here, if you don't trust me, you can well, I'm not sure you should trust these guys more, but anyway, they're more famous than me. Bernanke and Summers. They debate secular stagnation. This has been a big debate recently. So where Summers arguing, well, maybe secular stagnation, maybe we're in this permanent situation under which things are just not going to grow like they used to, and how do we? And that's a fundamental problem. Bernanke writes, you know, responding to this, he's skeptical of this. He sees the recovery in the U.S. in full employment. Perhaps those investment numbers give you a little bit more optimistic notion. But this, there's been future episodes of. If you look pre-financial crisis, under which the macroeconomy seemed to be growing very well, there was something called the Great Moderation. Macroeconomists post the big recession in the early 80s said, well, we're now on a much more stable path. Uncertainty seems to have been reduced, and this is some permanent phenomenon. Lots of papers were written in the academic literature about explaining the Great Moderation from a theoretical perspective. And then the financial crisis comes, and those explanations kind of disappear fast because our knowledge base just got challenged. You know, so we go through these situations where we think we have things understood, but you know, maybe we really don't. And I think a more open approach to this acknowledges this uncertainty. And this uncertainty, if economists don't have this stuff figured out, then presumably people inside our models don't either. And I think that's an important thing to be including here. So there's evidence from financial markets. There's a private sector observation. I don't like this language so much, but there's claims of measurement in financial markets of so-called risk on and risk off, that investors' appetites for risk rise and fall over time. And I think maybe this has to do with coping with uncertainty, but I think more narrowly defined risk is probably not the right label for this, but this is what the term used there. There's an academic literature, empirical evidence. There's lots of measurements have shown that the so-called risk-return trade-offs coming out of financial markets. So if I look at financial markets, I get some indication by looking across securities and their differences in expected returns, what the kind of risk-return trade-offs are. You know, how much compensation in financial markets are you getting for exposure to risk? These trade-offs seem to fluctuate over time, and the measured risk-return trade-offs there's lots of evidence for this. And there's a notion that risk prices are bigger in magnitude sometimes than others. And most of the reasons people give for this are either the so-called exogenous shocks that hit the system or other notions of risk aversion getting big sometimes and small other times. But to me, I think a more interesting notion has to do with can we trace this back to more broader notions of uncertainty? So I think this evidence poses a challenge to model builders. What explains these movements? And we have models that accommodate them, but we don't have many models that actually explain them, in my view. And I think this is critical. So there's this connection between there's macro uncertainty out there, which I've tried to argue for. There's also this known connection between the behavior of risk-return trade-offs and kind of good and bad times in the macroeconomy, and how might we connect these. So I think by broadening the notion of uncertainty can really be a contributor here. Investors struggle with how to perceive the future in a meaningful way. The approaches struggle with differing degrees of confidence in their beliefs. Maybe they have more confidence in some across different models in some periods than others. This impact of this struggle can vary over time as new evidence or new perspectives emerge. There's some very interesting contributions that have come out of decision theory under uncertainty that I think can provide tools to help think about exactly this. How can we actually capture this notion of our perspectives on different models changing over time? If we're in a position of trying to slant models or adjust models based on what their adverse consequences are, then our perspective on what are good and bad models itself will fluctuate. And this can be very intriguing sources of fluctuations. So the work that I've been doing with Tom Sargent and others is trying to figure out how to build on these insights from decision theory to help us get a quantitative story for these linkages between the macroeconomy and financial markets based on these investor struggles. So now let me turn a little bit more, let me turn to some policy questions in uncertainty. This is another University of Chicago economist. It's Hayek. Hayek shared the Nobel Prize with Myrdal, and I think he was probably fairly grumpy about that, but I don't know. He writes a rather intriguing address in his Nobel address, if you read it. He basically challenges the extent to which economics is a science. So he just wins the Nobel Prize in economic sciences, and you're commissioned to write a paper, and the paper is, well, to what extent is economics really a science? But it's actually quite an intriguing read. This is a quote from it that I don't agree with a lot of aspects of that essay, but I agree with some aspects of it. And I kind of like this particular quote. Even if true scientists recognize the limits of studying human behavior, as long as the people, the public, have expectations, there will be people who pretend to believe that they can do more to meet popular demand than what is really in their power. We kind of have a public sector, we have a kind of a public discourse of economics that plays to confidently held opinions that don't always recognize the uncertainty in the answers. And I think this can often be counterproductive. Our politicians like economists, so they'll tell them how to fix things. But if the knowledge base is weak, then why is that confidence necessarily helpful or say even justified? So I do believe that uncertainty can be a fairly subtle construct, but on the other hand, I think it can there's much gains to be added by including it more in public discourse. So let me give you some examples that I think that have some relevance here, and I could do more. So think about the oversight of financial markets. There's a construct that came into play called systemic risk. If you look at this construct pre-financial crisis, it was not talked about very much at all in the academic literature. Since that time, you'll see tons of references to it, and it's become a grab bag of scenarios for rationalizing interventions in financial markets. Now I have no doubt that if we're going to be in the position of bailing out financial firms, we have to also be watching them. So I don't want to argue we should turn the green light loose. There should just be a green light. But we're asking our regulators to do stuff that may be more ambitious than we actually have the knowledge base to support. So I think I would prefer to call the systemic risk as systemic uncertainty more broadly conceived, because we don't have well-defined, agreed-upon measures of it, well-defined, agreed-upon notions of what the construct really is. And there are people in the policy arena that write on this and acknowledge this. Andy Haldane from the Bank of England has written some very important discussions and say, look, we're being asked to engage in this oversight of financial markets, and the economic net knowledge base remains somewhat thin. And Trullo would write the same way. Has written, basically conveyed a very similar message. And I think these are important messages to have out there. So this leads to the following question. at the time of the financial crisis, I would often go to conferences about systemic risk. And there'd be these arguments coming from people from the policy arena. Financial market oversight is a very complicated problem. Therefore, it requires a complicated solution. And I'm not sure the latter follows from the former, especially when our knowledge base is quite limited. I'm willing to agree that financial market oversight is arguably a complicated problem. But once we acknowledge the limits of our linkages between financial markets and the macroeconomy, it's not really clear that the best outcome is then to manufacture complex solutions. Specific models, which with all their detail might well have a complex solution implied by it. But if I'm unsure about the model, if I'm unsure about the nature of that model, if I have to look, and I start looking across models, then maybe I'll be led to much more robustness concerns, to get policies that perform quite well in a variety of alternative models instead of just targeting one specific one. And simple, robust rules can also avoid uncertainty due to the economic environment. They can avoid regulatory discretion and the like. So I think once we acknowledge the limits to our understanding, that we may well be led to more simple solutions to complicated problems. Here's Basel 1, 2, and 3. This is a little bit unfair, but this is the pages of the Basel Arrangement. So they're not getting simpler. The Dodd-Frank bill, which was passed in the U.S., is. I would like to say that I've read it. I've looked at portions of it. It would take me a long time to read the Dodd-Frank bill. It is very long and very much involved. So we're not. Simplicity doesn't seem to be the direction we're headed in this arena, but perhaps it would be nice to pay more attention to it. So climate change and policy. Here's there's been interesting public debate about this, and this plays off of climate models we have there, like economic models. They're flawed. They have problems. They have gaps. They're not perfect. And climate scientists are worried about if too much knowledge of this might lead the public to just dismiss them because it can still be informative. And there's this very nice op-ed in the Wall Street Journal by Stephen Koonin, the former Undersecretary of Science in the U.S. Department of Energy. And to me, she's making a very important point in this arena as well. Any serious discussion of this changing climate must begin by acknowledging not only scientific certainties, but also uncertainties, especially in projecting the future. Recognizing those limits rather than ignoring them will lead to a more sober and ultimately more productive discussion of climate change and climate policies. So I think there's some concern that if we as academics or say that our models aren't perfect, that means that we'll be arguing we do nothing. Well, that's not the argument here. It's not that we do nothing. Once we acknowledge these uncertainties, which is not the same thing as saying that we should just have a pure status quo when it comes to policy. But on the other hand, it opens the door to more prudent policy making, I think, and ones that might be more sensible, and ones that we could refine down the road as our knowledge base expands. So let me kind of summarize where the topics I've tried to discuss here. To me, as a researcher, there's two perspectives on uncertainty. There's that outside the model and that inside the model. There's multiple components to uncertainty. There's this model risk. If you write down a model, it tells you probabilities of everything. And then we can see how people respond to the outcomes. There's model ambiguity. How much confidence do we place in each model? This is kind of subjective probabilities of DeFinetti and Savage confronted this. But DeFinetti and Savage both knew the limits of the subjective probability. And both are on record as saying subjective probabilities are things which we are going to only know with some imprecision. And then finally, and perhaps the most important one, is model misspecification. The models we write down as economists and use for quantitative purposes, they're wrong, but we still think they're insightful. How do you use models that are not perfect and acknowledge the limitations? I don't have a general theorem in this for this last point, but I just want to raise this as a possibility. Given the limits to our understanding, complicated problems may not always be may sometimes be best addressed with simple solutions. With that, let me just end with the following. I don't want you to come out of this talk with too negative a view of things, but let me put this rather negative statement from Mark Twain. Education is the path from cocky ignorance to miserable uncertainty. So maybe uncertainty is miserable, but I think it's important that we address its head on and acknowledge its presence. Thank you very much.